You might have the perfect trading setup, but if you miss just one key condition, your entire trade could fail. That's why I never take an entry without running through my A+ ICT entry checklist. Once I have that bias or direction locked in, I use this checklist to confirm all the requirements before pulling the trigger. Let's take a look into the checklist, and then we'll go through some examples using it. I focus on a few key things, and we'll go through them step by step. The first thing I focus on is a liquidity sweep. This simply means that a previous high or low has been taken out. Price reaches beyond it before reversing. Now, there are a few types of liquidity you'll see in the market. We've got equal highs and equal lows, which are retail targets sitting right above or below structure. Then we have internal liquidity, which builds up inside a range, and external liquidity, which sits outside the range, usually the major highs and lows that everyone's watching. When price sweeps one of these levels, especially external liquidity, it often gives us a strong clue that the market might be ready to shift direction. So, the first step in my checklist is confirming that liquidity has been taken, that a low or high was swept before I even think about an entry. The next thing I look for is a market structure shift, also known as a displacement. This simply means that price has broken a previous high or low with strength and momentum, not just a small wick or a slow grind, but a clear and aggressive move that shows a shift in control from one side of the market to the other. In other words, if we've just swept sell-side liquidity, I want to see buyers step in and completely take over, breaking a previous swing high. That's what confirms that the short-term trend might be reversing. This shift tells me that the market is no longer just collecting liquidity, it's now moving toward a new target or direction. Once I see that clear displacement, I know it's time to move on to the next part of the checklist. The next thing I look for is a retracement into a discount zone, and this is where there's a little bit of flexibility in my checklist. After a market structure shift or displacement, I generally like to see price pull back into a discount of the recent price range, meaning somewhere below the 50% mark of that impulse move. This is where I start looking for high probability entries, because price is essentially offering a better deal to go in the direction of the new trend. Sometimes price will tap perfectly into a fair value gap or an order block within that discount range, and other times it might just respect the equilibrium zone. The key idea is, I want to avoid chasing entries at the top of a move. Instead, I wait for price to come back into a favorable area where risk-to-reward makes sense. The next thing I look for is a PD array, which is simply an area within that discount zone where price is likely to react. Generally, I prefer to see price return to a FVG or an IFVG or an order block, because those areas often act as strong points of interest, places where institutional traders are likely reloading their positions. But I'm also flexible here. Sometimes, instead of a clean order block or FVG, price will respect a breaker block or even form a dealing range target within the same zone. These setups can still give me solid confirmation that price is ready to continue in the direction of the new structure shift. I know this might seem a little messy at first, so let's break it down and look at each concept individually. Each one of these ideas, whether it's a fair value gap, an order block, a breaker block, or a DRT, can actually be used as a complete entry model on its own. However, in my personal strategy, I like to blend 2 or 3 of these concepts together to build higher quality setups. For example, I might look for a fair value gap that lines up with an DRT, or I'll look for an IFVG that forms right inside that DRT level. There are plenty of different ways to combine these concepts. It really comes down to what fits your eye and your experience. Over time, you'll start noticing which combinations work best for you and in which market conditions they appear most often. Now, let's take a look at a few chart examples so you can see exactly how I apply this checklist in real time. For this first example, we're looking at gold on the 5-minute chart. I want you to watch how price reacts as it trades down into this 1-hour fair value gap fill below. As we let this play out, the first thing to notice is that we have sell-side liquidity resting right here. We now have our sell-side liquidity sweep followed by a market structure shift. That gives us confirmation to start looking for an entry model. Now let's go through each concept individually. First, discount and premium. Within this displacement range, I'm not looking to go long above the 50% mark. I want to enter somewhere in this discount zone, which I've highlighted in green. Taking that a step further, I'll refine this using the DRT, or Dealing Range tool. This shows me that my premium area is up here, where I definitely don't want to be longing, and my refined discount range is right here inside the DRT zone. Next, I can look for a fair value gap, and we have a one right here. Then we have an order block, which is this down close candle just before the move up, and finally a breaker block, represented by these up close candles that formed before the raid on liquidity. So now that all these concepts are visible, how do I decide where to actually take the entry? It really comes down to risk to reward and what stands out to me visually. The closer my entry is to the stop loss, the higher my potential reward, but the risk is that I might not get filled. So I try to find a balance between precision, probability, and execution. In this particular setup, here's what I'd do. First, I'd mark out my DRT, then I'd look for a PD array around that area. Inside that zone, I can see a fair value gap nested within an breaker block, which also lines up with the 50 DRT level, giving me multiple points of confluence. My entry would be right here, with my stop loss below the 25 DRT, first partial at this level, and my final target at the buy-side liquidity above. This is exactly how I use the A ICT Entry Checklist in real time, combining structure, liquidity, and premium discount concepts to find high-probability setups. Alright, let's look at the next example. Here, after taking the buy-side liquidity, the price started to drop, and once it closed below the last low, our market structure shift was confirmed. Now we'll start and go through our checklist. We identify the premium and discount zones and mark the DRT levels. After that, we look for PD arrays within the premium zone. Around the 75 DRT level, we have a strong FVG that overlaps with an IFVG. This is where I'll be looking for an entry, and that's enough confirmation for me to take a trade. I enter at the midpoint of the FVG, set my stop a few pips above it, and target below this low. As the price moves, you can see that I hit my target within just one candles. This repetition, seeing the same concepts play out across multiple time frames, is what builds confidence. So, just to review everything, here's the A ICT Entry Checklist one last time. A stop raid or liquidity sweep. A shift in market structure confirming direction. A return to equilibrium or DRT levels. A PD array that catches your eye, whether it's a fair value gap, inverse fair value gap, order block, breaker, or DRT. And finally, risk management, finding the balance between precision, risk to reward, and execution. I hope you found this video helpful and picked up some value from seeing how I apply these concepts in real time. If you did, please consider liking the video, subscribing, and dropping a comment below to let me know what examples you want to see next. Thanks for watching, and see you in the next one.